What if the amount a bank approves you for is actually the fastest way to become financially stressed? Millions of people buy homes based on approval numbers, not real-life budgets, and many regret it. A home should create stability, not pressure. So how do you know what you can truly afford without becoming house poor? Let's break it down. Part 1. Bank approval is not real affordability. Mortgage lenders calculate how much they're willing to risk, not how comfortable your life will be. They look at income, debts, credit score, and payment history to determine whether you can technically make the payments. But they don't consider your daily expenses, future plans, or personal priorities. They don't know if you want to travel, start a business, support family members, or build aggressive savings. Because of that, approval amounts are often much higher than what feels manageable month to month. Many buyers assume approval equals safety, but it only means the bank believes, you'll pay them back. True affordability is about maintaining financial stability, flexibility, and peace of mind long after the excitement of moving in fades. Part 2. The hidden costs of owning a home. A mortgage payment is only one piece of the total cost of home ownership. Property taxes, insurance, maintenance, utilities, and repairs can add hundreds or even thousands to your monthly expenses. Unlike renting, you are responsible for everything that breaks. Roof leaks, plumbing issues, appliance failures, and structural problems don't wait for convenient timing. Even routine upkeep like painting, landscaping, and servicing heating or cooling systems costs money every year. A common guideline is to budget about 1 to 3% of the home's value annually for maintenance alone. On a moderately priced home, that can equal several $1,000s per year. Ignoring these costs is one of the biggest reasons homeowners feel financially overwhelmed after purchase. Part 3. The 2836 Rule and its limits. Financial institutions often use the 2836 Rule as a benchmark. This guideline suggests spending no more than 28% of gross income on housing and no more than 36% on total debt payments. While useful as a starting point, it doesn't reflect real life for many households. It's based on income before taxes, retirement contributions, and insurance deductions, money you never actually see. It also assumes average expenses, which vary widely depending on childcare costs, healthcare needs, transportation, or student loans. For greater safety, many financial experts recommend keeping housing closer to about 25% of take-home pay. That lower percentage creates room for savings, investing, emergencies, and lifestyle choices that make life enjoyable rather than restrictive. Part 4. The risk of becoming house poor. Being house poor means your home consumes so much of your income that little is left for anything else. From the outside, it may look impressive. A large house, a desirable neighborhood, a major life milestone achieved. But inside the budget, stress builds quickly. Savings slow down, retirement contributions shrink, and everyday expenses start to feel burdensome. Vacations, hobbies, and spontaneous experiences disappear because the mortgage dominates your finances. Even small unexpected costs can trigger anxiety. Over time, this pressure can reduce quality of life and delay long-term financial progress. Wealth is built through consistent saving and investing, not just owning expensive property. A slightly smaller home with manageable payments often leads to far greater freedom and security. Part 5. Questions that reveal true affordability. Instead of focusing on maximum approval, evaluate how the purchase fits your overall financial life. Can you still save a meaningful portion of your income each month after paying for the home? Do you have an emergency fund large enough to handle repairs or temporary income loss? Would the payment feel manageable if expenses increased or income dropped? Consider whether buying this home forces you to give up important goals such as education, travel, or career flexibility. True affordability includes margin, extra space in your budget that absorbs shocks without panic. A home should support your life, not trap you financially. If the numbers leave no breathing room, the price is probably too high, regardless of what lenders approve. Part 6. A practical real-life method. A simple way to estimate a safe housing budget is to start with your monthly take-home income rather than gross pay. From that amount, subtract your savings goals, debt payments, insurance costs, food, transportation, and other essential living expenses. Also account for lifestyle priorities that matter to you, whether that's travel, hobbies, or supporting family. The money remaining represents what you can comfortably dedicate to housing without sacrificing stability. If the result feels tight on paper, real life will likely feel even tighter. This method focuses on sustainability instead of maximum borrowing power. The best home is not the most expensive one you can qualify for, but the one that allows you to live confidently while still building a secure financial future. Part 7. The importance of a strong down payment. The size of your down payment has a major impact on how affordable a home truly is. A larger down payment reduces your loan amount, lowers monthly payments, and can eliminate extra costs like private mortgage insurance. It also provides immediate equity, which acts as a financial cushion if home values fluctuate. Buyers who stretch to purchase with minimal savings often face higher stress because they have little margin for emergencies after closing. While waiting to save more may feel frustrating, it can dramatically improve long-term stability. A strong down payment doesn't just make approval easier, it makes ownership safer. Entering homeownership with cash reserves and equity means you're far less likely to feel trapped by your mortgage. Part 8. Affordability. Should include your future, not just today. Many buyers base affordability only on today's income and expenses, but life changes. Jobs, families, health, and the economy can all shift. A home that feels manageable now could become stressful later. Smart buyers plan ahead. Think about whether you want children, career flexibility, or the option to reduce hours in the future. Choosing a slightly lower payment today gives you freedom tomorrow. True affordability means your home still feels comfortable 5 or 10 years from now, leaving room for life's changes and long-term peace of mind. Part 9. The cost of ownership goes beyond the purchase price. The price you pay for a home is just the starting point. Over time, interest, property taxes, insurance, repairs, and major replacements can cost far more than you expect. Roofs wear out, systems fail, and expenses slowly rise year after year. Many buyers focus only on the purchase price and overlook the long-term cost of living there. True affordability means you can maintain and live in your home comfortably for years, not just afford to buy it today. If you found this helpful, check out the next video on smart home buying mistakes to avoid before signing a mortgage. Don't forget to like, subscribe, and share this with someone planning to buy a home soon. Your future self will thank you for making a decision based on freedom, not pressure.